Investors digesting a fresh round of economic data this morning. Wholesale inflation unexpectedly contracted 0.5% during the month of April, reflecting a slump in margins, suggesting companies could be absorbing some of the hit from higher tariffs. That inflation reading coming as retail sales for the month were largely flat. Michael Darda, Roth Capital Partners chief economist and macro strategist, is here to break it down. Michael, great to have you on here to make sense of this for us. It feels like PPI is the star of the movie this morning here. Talk to me about what it means for consumers and for companies.
Absolutely. Thank you for having me on. Not much pipeline inflationary pressure, at least so far. And we also had a good CPI reading that was quite calm for April. So, I think there's a little bit of uncertainty here in terms of if this is just temporary before the tariffs start to hit. We think there's going to be some upward pressure from the tariffs, but critically, if these numbers were well behaved going into the tariff storm, I think that'll give the Federal Reserve a lot more confidence that in the event that they need to support the economy with a lower policy rate, they'll be able to do so. Now, President Trump has backed off some of the most aggressive proposed tariff increases, particularly on China. So at the margin, that helps as well. If the tariff shock is less intense, the economy is less disrupted, then there'll be less of a need for the Fed to potentially support growth. So all of that has played out, obviously, in very buoyant financial markets. And, today we're getting a bit of a pullback, but it's been one heck of a run over the last month.
Michael, with that in mind, and that key point that you made a moment ago, and that there was the chaos up front and then the kind of quick about face once the market started to scratch or be in the area of bear market territory. And it was like, okay, wait a minute. We don't want that on our hands. We're also hearing from some of the company CEOs about shelves not being able to be stocked later on. So we need to back off, as you were mentioning, step off of some of the more harsh tariffs and continue to figure out what negotiations can net out in the details here. So what is the likelihood that we would see, and how so would we see the tariff impact actually flow through to some of these numbers if companies are saying, hey, just keep that vessel out there for as long as you can until we hear some of the walk back?
Yeah, exactly. A lot of good points there. I mean, I guess we figured out where the Trump put is. Coming into the year, markets were overly optimistic that the whole tariff bluster was just that, a bluff. And then the Liberation Day tariff proposals were so much more aggressive than what the market had anticipated. That threw us into a bit of a tailspin. And at least initially, it didn't really look like the administration was going to react to financial market upheaval. And then they eventually did, I think, when the bond market started to shoot yields higher, even with risk assets falling, which was kind of a scary moment in early April. That's not the typical association configuration that you would see. So the administration has softened and backed off, and that certainly helped things. Now, look, I mean, the average effective tariff rate is going to still be rising pretty dramatically from where we were before we came into this year. It's just not going to be as extreme. So we still will see a disruption in the business cycle. We'll see some pressure on inflation. But the key is, if that's going to be temporary and less extreme, then risk markets don't have to price in the recession probabilities going above 50%, which was the case coming into April.
How does this impact profit margins going forward? And I ask you that in the context of some commentary we're getting in from Fed Chair Jerome Powell talking about how supply shocks could be consistent. And then within this PPI print, you have a proxy number for profit margins easing in April. That's good for consumers, but bad for profits, and maybe in part why we're seeing a little bit more pressure on the stock market right now. How do you weigh the impact of supply shocks and potential profit margin concerns when you're thinking about earnings growth going forward?
Oh, for sure. Yeah, I think, the tariffs are definitely going to at least cause a temporary period of weakness for corporate earnings. The question is, how severe that is and how long it lasts. The good news is that we've seen very moderate wage growth consistent with price stability. And so I mentioned before, that puts the Fed in a very good position if they do need to respond to economic weakness. And markets really priced this in real time. We had almost a 19% decline in the S&P 500 from peak levels February to early April. And so the market, we had analysts expecting 14% earnings growth, and the market obviously, priced that out pretty rapidly. In this rebound until today, I think is a reflection of an expectation that, yes, temporarily it will disrupt the economy and earnings, but that won't be long lasting. So we'll see whether it plays out that optimistically. On the productivity side, we've been getting some good numbers until the most recent reading, which I think was a bit of a distortion. So if the AI story can continue to play out and we have relatively good productivity statistics going forward, that long term will help corporate profitability. But there's no doubt that we're going through a period of uncertainty and disruption here.